Imagine waking up to headlines declaring that Britain's once unbreakable housing market is finally cracking. Mortgage rates remain sky high, for sale signs linger for months, and anxious homeowners watch as prices quietly slip week after week. The question on everyone's mind isn't whether the market will cool, it's whether the bubble will burst in 2026. Behind the glossy estate ads and government reassurances, warning lights are flashing across every sector. From rising debt to investor flight, experts are asking, has the UK housing dream reached its breaking point, or is the storm that's coming far worse than anyone expects? Number 10. External shocks and unpredictable global factors. Even the most carefully managed economy cannot shield its housing market from external shocks, and 2026 may bring several that test the resilience of the UK property sector. Global events such as geopolitical conflicts, energy crises, or sharp fluctuations in commodity prices can ripple across borders with astonishing speed. The UK, being deeply interconnected with global financial systems, remains vulnerable to these disruptions. A renewed escalation in Eastern Europe or instability in the Middle East could send energy prices soaring again, driving up inflation and forcing the Bank of England to maintain high interest rates longer than expected. At the same time, trade disruptions or supply chain bottlenecks could limit the availability of construction materials, halting projects and inflating building costs. When uncertainty grows on a global scale, investor confidence weakens, and the first casualty is often property, a market highly sensitive to sentiment, financing, and stability. Financial markets also pose a significant risk. A sudden downturn in global equities or a major correction in bond markets could lead to reduced investment liquidity. Pension funds and large institutional investors, both major players in commercial and residential real estate, might rebalance portfolios away from property, starving the sector of capital. Meanwhile, volatility in currency exchange rates could deter foreign buyers who have long supported high-value segments of the London market. If the pound strengthens sharply, overseas investors may look to cheaper alternatives in Europe or Asia, further cooling demand. Economic shocks abroad, particularly in the United States or China, can indirectly squeeze the UK through diminished trade, weaker exports, and reduced investor appetite for British assets. The housing market, dependent on confidence and credit, tends to amplify these external tremors rather than absorb them quietly. Natural disasters and climate-related events add another unpredictable layer of risk. Severe floods, wildfires, or extreme weather can destroy infrastructure, disrupt insurance markets, and render certain areas less desirable or uninsurable. These factors may accelerate regional disparities, where climate-resilient zones hold value, while vulnerable regions see steady decline. Analysts caution that systemic shocks, whether environmental, financial, or geopolitical, tend to expose existing market fragilities rather than create new ones. If multiple shocks coincide, the result could be a chain reaction of declining confidence, restricted credit, and forced sales. The greatest threat to the UK housing market, therefore, may not arise from domestic policy, but from the unpredictable waves of global instability capable of turning a slowdown into a lasting structural downturn. Number 9. Liquidity and credit crunch risk. A looming credit squeeze could become one of the most destabilizing elements in the UK housing market by 2026. When the flow of credit tightens, property transactions slow dramatically, creating an environment where even healthy markets can stall. Banks and financial institutions, cautious after years of rising defaults and economic uncertainty, may begin restricting mortgage approvals and raising deposit requirements. The knock-on effect is immediate: fewer qualified buyers, reduced demand, and falling transaction volumes. For developers, the challenge is even more acute. Construction projects rely heavily on short-term financing, and when that liquidity dries up, building halts midstream. Delayed completions, abandoned developments, and distressed sales become common symptoms of a credit crunch, eroding confidence across the sector. This scenario mirrors the early warning stages of the 2008 crisis, though today's banks are better capitalized. Even so, A squeeze on liquidity can paralyze the market without triggering an outright collapse, leaving thousands of unsold homes and idle capital. The danger extends beyond home buyers and developers to the broader financial system. A tightening of credit means banks hold larger reserves, effectively removing money from circulation and stifling economic growth. Businesses dependent on the housing sector, from construction suppliers to conveyancing firms, experience cash flow strain. The Bank of England faces a delicate balancing act. Lowering rates too quickly risks reigniting inflation, while keeping them high suppresses lending and economic recovery. If inflation persists, lenders may also increase their risk premiums, further pushing up mortgage costs. Once trust between lenders and borrowers weakens, liquidity evaporates. When financing becomes expensive or unavailable, sellers must accept lower prices to attract cash-ready buyers, which compounds the deflationary spiral. Market analysts warn that the UK's high debt-to-GDP ratio magnifies these vulnerabilities. With households already carrying substantial personal and mortgage debt, even minor disruptions in credit supply can create cascading effects. Property developers with large exposure to floating-rate loans are particularly at risk. A sudden credit freeze could force them into insolvency, releasing more distressed assets onto the market. Meanwhile, institutional investors may retreat to safer instruments such as government bonds, draining further liquidity from real estate. Although policymakers have introduced measures to support lending through state-backed guarantees, confidence remains fragile. Without stable credit channels and predictable financing conditions, housing markets cannot function efficiently. By 2026, liquidity risk stands as a silent but potentially explosive threat, capable of transforming a gradual slowdown into a full-blown housing freeze. Number 8. Investor and landlord. Exit with sentiment shift. Investor sentiment is one of the most influential psychological forces in the housing market, and in 2026 it appears to be turning decisively negative. A combination of regulatory pressure, falling yields, and high financing costs has made property investment far less attractive than in the previous decade. For many landlords, rising interest rates have wiped out profit margins entirely. Mortgage repayments now exceed monthly rental income in some regions, forcing owners to either raise rents, which tenants increasingly cannot afford, or sell their properties. This trend is accelerating as more landlords choose to exit while values remain relatively high. What began as a trickle of sales in late 2024 has turned into a steady wave, adding thousands of extra listings to an already cooling market. The cumulative effect of these sales is a rise in available stock, which puts downward pressure on property prices and undermines confidence across the sector. The shift isn't just financial, it's emotional. For years, property was seen as the safest and most rewarding investment in Britain. Generations of investors viewed it as a stable path to long-term wealth. Now, that perception is fading. Tax hikes on rental income, stricter environmental standards, and the phasing out of Section 21 no-fault evictions have changed the risk profile of buy-to-let ownership. Larger institutional landlords may be able to absorb these pressures, but small and mid-sized investors, who make up the bulk of the rental market, are finding the balance unsustainable. Many are liquidating portfolios to reduce exposure before potential price drops worsen. Their departure creates a feedback loop. More supply leads to lower prices, and lower prices discourage new investors, amplifying the decline in confidence. Foreign investors, once dominoes, and in prime London and key regional markets, are also retreating. Currency volatility, political uncertainty, and global interest rate changes have dulled the UK's appeal. This withdrawal removes a vital source of liquidity and prestige from the upper tiers of the market, often cascading down into lower value segments. Analysts warn that when investor psychology turns pessimistic, markets tend to overshoot on the way down, as fear replaces speculation. Without new incentives or clear policy direction, the exodus of landlords and investors could reshape the housing ecosystem entirely, pushing ownership back toward a smaller, less dynamic core of homeowners. By 2026, This shift in sentiment stands as one of the most potent accelerants of the UK housing market's ongoing fragility. Number 7. Weak demographics and population shifts. Demographic forces, often overlooked in short-term forecasts, are becoming a powerful variable shaping the UK housing market in 2026. The population growth rate has slowed dramatically since the late 2010s, driven by falling birth rates, tighter post-Brexit immigration policies, and an aging population. While immigration still contributes to overall population expansion, the regional distribution of people is shifting in ways that could leave some housing markets vulnerable. Urban centres like London and Manchester continue to attract younger professionals, but smaller towns and certain rural regions are witnessing net population decline. When demand diminishes in these areas, homes remain unsold longer and prices stagnate. This imbalance between regions could deepen inequality within the housing sector, where a few high-demand zones maintain stability while others slide into prolonged downturns. Demographic cooling doesn't cause a crash overnight, but it gradually removes the oxygen that fuels consistent property appreciation. The aging population also transforms housing demand itself. Older homeowners tend to hold onto properties longer, reducing market circulation. At the same time, their preferences shift toward downsizing or moving into retirement-friendly communities, which creates localized surpluses in family-sized homes. Younger generations, facing stagnant wages and high rent, find it increasingly difficult to step onto the ladder, further slowing the turnover rate. As a result, the market becomes less dynamic, with fewer transactions and weaker price growth. Developers are also grappling with these demographic realities. The demand for luxury flats and high-density urban apartments may soften if younger buyers continue to delay purchasing. Meanwhile, regions once buoyed by immigration-driven demand, such as certain parts of the Midlands and East Anglia, may see reduced pressure on housing, leading to small but steady declines in property values. Another growing concern is the migration of remote workers away from major cities. The pandemic accelerated flexible working habits, and while many firms are returning to offices, hybrid models remain common. Workers seeking affordability have been relocating to coastal towns or smaller communities, initially boosting prices there. However, as the trend matures, saturation sets in and demand stabilizes. Areas that overexpanded to accommodate this wave could experience sharp corrections if economic opportunities fail to keep pace. Over time, demographic and lifestyle shifts form a quiet but persistent drag on national housing demand. Unless the UK adopts policies that encourage balanced regional growth and family formation, weakening demographics will continue to act as an invisible brake on property prices through 2026 and beyond. Number 6. Changes in taxation and regulatory risk. The UK property market in 2026 faces mounting uncertainty from potential taxation reforms and regulatory shifts that could reshape investor behaviour and homeowner confidence. The government, under pressure to raise revenue and address inequality, has hinted at revisiting property-related taxes such as stamp duty, capital gains tax, and council tax. Even minor adjustments in these areas can have major ripple effects on market activity. A rumoured move toward a proportional property tax or a higher rate on second homes has already stirred concern among landlords and investors. Policy uncertainty discourages long-term commitments as buyers wait for clarity before making major purchases. Homeowners planning to sell may also delay transactions, anticipating less favourable tax conditions. This pause in market activity compresses liquidity and lowers transaction volumes, creating the appearance of weakness even before any official policy changes take effect. For landlords, the regulatory landscape is growing even more challenging. Recent reforms have expanded tenant protections, increased maintenance obligations, and tightened restrictions on evictions. These changes, combined with higher mortgage costs, are squeezing rental yields to record lows. Many landlords, particularly smaller ones, are choosing to exit the market altogether. When a significant number of investment properties hit the market simultaneously, it increases available housing stock and applies downward pressure on prices. Large property owners may weather the impact, but widespread exits from private landlords could redefine the structure of the UK rental sector. Meanwhile, first-time buyers hoping to benefit from these sales face the same high deposit and affordability barriers, preventing the market from smoothly absorbing the extra supply. Policy unprecedented. Suitability also affects foreign investors, a group that once provided strong demand in London and other key cities. Uncertainty over tax residency rules, ownership transparency laws, and potential wealth taxes has already prompted many overseas buyers to look elsewhere in Europe. This retreat reduces capital inflow and further cools high-end markets that often set the tone for national trends. Economists warn that the UK's heavy dependence on property-related tax income leaves policymakers walking a fine line between fairness and fragility. Too aggressive a tax change could backfire, triggering panic selling and undermining broader economic stability. Until regulatory direction becomes clearer, tax and legislative volatility will remain a dark cloud hanging over the 2026 housing outlook, shaping investor sentiment and dampening the willingness to take new financial risks. Number 5. Supply increase and overbuilding in some regions. Another factor that could weigh heavily on the UK housing market in 2026 is the uneven rise in housing supply, particularly in regions experiencing concentrated development. While much of the national debate focuses on the chronic shortage of homes, some local markets are quietly edging toward oversupply. Government incentives for builders, relaxed planning rules, and post-pandemic construction booms have led to a wave of new housing starts in certain urban corridors and commuter towns. As these projects complete, the balance between supply and demand begins to tilt. When the number of available properties outpaces the number of qualified buyers, prices soften and competition among sellers intensifies. Estate agents in parts of the Midlands and the North have already reported more listings than active purchasers, a signal that the market's regional dynamics are diverging from the national narrative. Oversupply does not just pressure prices, it can also erode rental yields and strain the financial health of developers. Developers facing excess inventory often resort to discounts or buyer incentives, which can quickly cascade into broader market weakness. When one developer cuts prices to move unsold stock, neighbouring projects follow suit, dragging down valuations across the area. Builders holding large portfolios of unsold homes may also delay or cancel future developments, affecting construction jobs and local economies dependent on housing growth. At the same time, local councils, eager to meet housing targets, continue approving new projects without fully accounting for demographic shifts or migration trends. Some towns are witnessing more homes than households ready to occupy them, particularly where employment opportunities are limited. This imbalance creates micro-bubbles that inflate quickly and deflate just as fast when buyer enthusiasm fades. The consequences are most visible in new-build estates where resale values often dip below purchase prices once initial demand cools. Experts caution that oversupply in isolated regions could magnify the broader downturn if national confidence weakens. Investors who bought in bulk during the pandemic era may find it difficult to offload properties at acceptable margins, leading to distress sales. A wave of discounted transactions could, in turn, set new lower benchmarks that pull average prices down elsewhere. While the UK as a whole still faces a housing shortage, regional overbuilding pockets reveal how uneven development can destabilize the market. If construction outpaces realistic demand, particularly in areas with limited job growth, 2026 could mark the start of localized corrections spreading outward through the property chain. Number 4. Overvaluation and price correction pressure. For years, economists have warned that parts of the UK property market are overvalued, and 2026 may be the year when those warnings materialize into a broad correction. House prices across major cities have grown far faster than wages, leaving ownership increasingly out of reach for average earners. In London, for instance, the price-to-income ratio remains above 10, a level economists consider unsustainable. When property values become detached from real income growth, the risk of a downward adjustment rises sharply. Many experts now describe the housing market as being at its tipping point, where even minor economic or financial shocks could trigger a chain reaction of declining valuations. Rather than a sudden collapse, analysts expect a drawn-out price correction where values fall by 10 to 20% in overheated areas, while remaining flat or modestly down elsewhere. Such a decline would not only affect homeowners' wealth, but could also ripple through consumer spending and business confidence. The mechanics of a correction are often self-fulfilling. When potential buyers anticipate lower prices, they delay purchases, reducing demand and putting further pressure on sellers. As listing times lengthen, sellers begin cutting asking prices, reinforcing the perception that values are falling. The same dynamic impacts landlords and property investors, many of whom rely on rising prices to justify holding costs. Falling valuations can erode equity, complicate refinancing, and increase the risk of negative equity for those who purchased during peak years. This undermines mobility in the market as homeowners are reluctant or unable to sell at a loss. The situation becomes especially sensitive for buy-to-let owners who face both declining property values and tighter rental margins due to new regulations and higher maintenance costs. Experts emphasize that a correction does not necessarily equal catastrophe, but it does signal a rebalancing of expectations. If wages continue to lag behind property inflation, affordability will remain strained even after prices drop. The government's long-standing reliance on housing as a wealth engine also limits policy flexibility, as falling values threaten voter confidence and tax revenue. Financial institutions, however, are preparing for this scenario by stress-testing their mortgage portfolios against sharper price falls. The broader outcome depends on how quickly the market finds equilibrium between income and price levels. Until then, overvaluation will hover as a constant pressure point, shaping investor behavior and consumer sentiment throughout 2026. Number 3. Economic slowdown and recession risk. A potential economic slowdown looms as one of the most serious threats to the UK housing market heading into 2026. The nation's growth forecasts have already been revised downward, with analysts warning of stagnation driven by weak consumer spending, high borrowing costs, and declining business investment. When the broader economy falters, the housing market is among the first to feel the impact. Rising unemployment or even the fear of job loss discourages people from taking on long-term financial commitments, such as mortgages. Confidence plays a powerful role in housing dynamics. When households fear recession, they delay purchases, sell cautiously, and save more. Economic activity contracts as a result, creating a feedback loop that suppresses both property demand and overall growth. With GDP growth forecast to remain below 1% in 2026, the housing market may face a prolonged period of low momentum rather than a short-term correction. During economic downturns, even minor financial shocks can trigger significant housing consequences. Businesses facing lower sales often resort to layoffs, cutting the very income streams that sustain mortgage payments. For families already balancing elevated living costs, any disruption to wages or working hours can tip them into arrears. Analysts note that mortgage arrears have begun to rise quietly, suggesting early cracks beneath the surface. If energy prices or taxes climb again, disposable income will tighten further, pushing more homeowners toward distress sales. The commercial property sector, offices, retail spaces, and warehouses, is also cooling, which spills into residential construction through reduced demand for labor and materials. This intersection of weaker employment prospects and cautious investment sets the stage for a potential housing stagnation where prices drift sideways or gradually decline rather than collapse outright. Economists argue that the resilience of the housing market will depend heavily on government intervention and consumer sentiment. Should the Treasury extend mortgage support or tax reliefs, some stability may return. However, if inflation proves stubborn and forces the Bank of England to keep rates higher for longer, households will remain squeezed. A full-blown recession would not only hurt affordability, but also amplify fear, reducing liquidity and freezing transactions. History shows that recessions don't always destroy housing markets instantly, but they erode confidence layer by layer. Without stronger growth, wage recovery and targeted fiscal support, the UK's economic fragility in 2026 could quietly drain the life from its property sector. Number 2. Tightening lending criteria and affordability tests. The second major factor that could push the UK housing market toward a downturn in 2026 is the tightening of lending criteria by banks and building societies. As the financial environment grows more volatile, lenders have become increasingly cautious about who qualifies for a mortgage and how much they can borrow. Regulators have reinforced affordability stress tests, requiring lenders to ensure that borrowers can still meet repayments even if rates rise further. This move, while prudent from a stability perspective, inevitably reduces the number of eligible buyers. Many potential homeowners who could once secure loans under looser conditions are now locked out, especially those with irregular incomes, small deposits, or high existing debt levels. The consequence is a shrinking pool of qualified buyers, leaving more properties unsold and applying downward pressure on prices across several regions. For first-time buyers, these stricter rules create an almost insurmountable barrier. The average UK home now costs more than 8 times the average annual salary, and even with modest wage growth, saving for deposits remains a monumental challenge. With lenders demanding larger deposits, sometimes exceeding 20%, the gap between aspiration and reality continues to widen. Housebuilders who rely on consistent demand from entry-level buyers are also feeling the effects. New housing starts have slowed as developers hesitate to invest in projects that may not find immediate buyers. This stalling cycle undermines market fluidity, reducing overall transactions and weakening the sense of momentum that typically keeps property markets buoyant. When fewer people can secure mortgages, existing homeowners also struggle to sell, further freezing movement within the housing chain. Analysts warn that if credit conditions tighten further in 2026, even modest improvements in inflation or employment may not offset the damage. Restrictive lending feeds a self-reinforcing loop of hesitation. Fewer buyers mean fewer sales mean falling prices, and falling prices make lenders even more cautious. This phenomenon mirrors early warning signs seen before previous downturns, where overcorrection by financial institutions deepened the slowdown. Although tighter lending is designed to prevent reckless borrowing, its timing, arriving amid already high rates and weak confidence, may unintentionally accelerate a cooling market. Without some easing of these restrictions or innovative lending solutions, affordability constraints will remain one of the most potent brakes on the UK housing sector in 2026. Number 1. High interest rates and debt servicing stress. The first and perhaps most immediate threat to the UK housing market in 2026 lies in persistently high interest rates and the mounting pressure they place on household finances. Over the past few years, the Bank of England has raised rates to combat inflation, and while inflation has eased slightly, mortgage costs remain elevated. For millions of homeowners who fixed their rates during the ultra-low interest era, those deals are now expiring, forcing them to refinance at rates nearly double what they paid before. This shift has created what analysts call a refinancing cliff, where monthly payments jump by hundreds of pounds. For many middle-income families already stretched by high energy and food costs, these new mortgage burdens are unsustainable. Economic studies suggest that even a small rise in interest rates can significantly increase default risks, and with household savings eroded after years of inflation, the buffer against financial shocks is thin. Beyond individual borrowers, the wider property market also feels the strain. High borrowing costs slow down new lending, limit buyer enthusiasm, and reduce the number of first-time buyers entering the market. Fewer buyers mean longer listing times and falling asking prices, especially in areas where affordability was already stretched, such as London and the South East. Property developers and investors are equally cautious, scaling back construction projects or shelving planned developments due to financing challenges. The ripple effect extends into related industries: construction, furniture, and retail, further cooling economic momentum. Estate agents report that homes now linger on the market for months, and sellers are beginning to lower prices to attract offers. Experts from major financial institutions warn that if rates stay above 4%, into 2026, the risk of a systemic slowdown becomes real. Rising arrears and repossessions could erode consumer confidence, amplifying fears of a housing slump. While banks are better capitalized today than during the 2008 crisis, prolonged high rates test both lenders and borrowers. For the housing market to stabilize, mortgage rates must fall enough to restore affordability, yet not so fast that they signal economic distress. Until that delicate balance is achieved, high interest rates will remain the single most significant drag on the UK housing market, anchoring uncertainty and restricting any meaningful recovery. The outlook for the UK housing market in 2026 is defined by uncertainty, complexity, and risk layered across every level of the economy. While a total collapse remains unlikely, the pressures from high interest rates, tight lending conditions, slowing economic growth, and shifting investor sentiment create the conditions for a broad, uneven correction. Some regions may see only mild declines, but others, particularly those with overbuilding or heavy landlord exits, could face deeper and longer downturns. The greatest danger lies not in a single event, but in the slow accumulation of stress, reduced affordability, cautious lending, weak demographics, and fading optimism. If these forces converge, even a modest external shock could trigger sharp regional declines and test financial resilience across households and lenders alike. Yet within this fragile landscape lies an opportunity for reset. Falling prices could eventually restore affordability, allowing first-time buyers and new families to re-enter the market after years of exclusion. Stability will depend on government policy, rate movements, and consumer confidence, the three levers that can either soften or magnify the impact of 2026's headwinds. For now, the UK stands at a crossroads: adapt to a slower, more realistic housing era, or risk another painful cycle of boom and bust. One thing remains clear: the days of effortless property wealth are over, and what comes next will redefine how Britain sees value, ownership, and stability in the decade ahead.